FourStar Wealth Advisors 2016 Outlook will run 10 minutes and 16 seconds.
Well, hi folks, this is Brian Kasal, and I'm here with FourStar's commentary as we enter the first quarter of 2016. We'll talk about the year, and we'll go through a number of discussions. First about the economy, then about the markets in general, which have been very sloppy to date, our posture as a firm, things that you should be worried about or happy about, and then also just a segment on putting it all together, how to operate in this kind of an environment. So let's turn right to the economy. The U.S. economy for the fourth quarter grew at a very low rate, down from previous levels at 0.7%, so less than 1% growth for the first quarter. That announcement is due to have at least 2 revisions by the Fed over the next couple of months. So revisions usually happen in the direction of the initial announcement. So this announcement was lower than the previous quarter, so it could likely mean that the revisions take the number even lower than 0.7%. So hopefully it doesn't take us into negative territory. What does that mean? That means the economy is really slow in the fourth quarter. A lot of that has to do with what's going on in China and other areas of the world. We also have, we're getting back to 2008 levels in oil. So it's a sloppy time in the economy, albeit as our economy is still better than most economies in the world. Japan is undergoing some very difficult times as well. They've got serious demographic problems, meaning they have a lot of older people, and they don't have a lot of younger people supporting them. So their economy is deflating. So now they introduced, this is important news, they introduced negative interest rates. That means now, instead of getting interest from a bank, you actually pay a bank to hold your money, and it's actually designed to keep the economy from deflating any further. In the U.S., the durable goods orders fell 5.1% in December, so that's another sign that the economy was slow. So you see a lot of these different signals, and they all lead to a final gross domestic product number. So that number was down, and then a lot of the other coincident numbers that go into it were also down. Moving to China, the factory gauge in China fell for the 6th month in a row, which is a record, and it's clearly a problem in China. China is slowing down dramatically. Their markets are reflecting that. So Europe is in recession. Most of the countries in Europe are in recession. Most of Asia is in recession. So far, America's not in recession. So hopefully we don't go into it. The only good news, I think, is that even though the other economies of the world are really difficult, America's economy has been performing better. There's a flight to safety at all times when the economies are difficult. And however difficult the American economy has been, our economy still seems to be performing better. Our political environment is more stable than other countries. The unemployment rate, however, on the other hand, recently went below 5%. And so the politicians were making a big deal about that. And that is good, obviously. But at the same time, that's what we call the U3 unemployment rate. That's the one that the politicians talk about. The U6 unemployment rate is the people who are unemployed, and that number is still close to 10%. So it's still not a positive situation. In the labor markets, it's better, not great. The labor force participation rate is at the lowest levels in American history. There's positives and negatives to that, but it's clearly not a robust growth economy right now. So turning to the markets, we're down about 11% for the year after a flat to slightly down year in 2015. So the markets are very sloppy. This was the worst open to the U.S. stock markets in recorded history. The fact that the market was down in any one month, saying it's the worst open to the year, isn't material on its face. But the fact that it's down is obviously not a good thing. While we're in this really difficult stock market where the market's repricing assets lower, the worldwide markets are going down, part of it has to do with the debt overhang in the world and a lot of other things going on in the economies that aren't working. The markets are signaling that. We're also seeing some very interesting internals. We're seeing money flowing out of the fast growth biotech sector, flowing out of the general technology sector. We're seeing utility stocks acting better. We're seeing precious metals and some commodities that have been terrible for 4 or 5 years starting to bottom and show some strength. So there's always leadership changes here. Jim Cramer says this on CNBC as well. There's always a bull market somewhere. that we just need to make sure that we either get out of the bear market areas altogether, if possible, or find the possible bull markets. And there are bull markets, it's just they're not what people normally recognize, like gold or utilities or things that we're not normally looking at. So that's where we are. The market will bottom again. It always bottoms. It bottomed after the Depression. It bottomed after the Great Recession. So where we bottom, we don't know exactly. But when it does bottom, there will be lots of opportunities down there. So we're going to try and keep a lot of powder dry so we don't get hurt in these markets. So our posture in these markets, we have been defensive since last year. Now we have some models that we run portfolios with in our firm where as the markets start to sell off from the highs, we get signals to start raising cash. And if it's just a small correction, then eventually those signals will get us back into the market and we'll resume an upward trend. But the point is, we got signals that were negative and we never got enough signals to go positive, so we've been defensive since last summer. We got one more signal to be more defensive in early January, so we're about as defensive as you can be right now, that albeit that we still own a few stocks, but not many. A couple things I want to talk about, things to be worried about. In this kind of environment, everyone is looking to get a little bit of income. Certainly retirees are looking for income. With interest rates at zero and interest rates are staying low for a while and probably will stay low for a while, there's not a lot of income coming out of portfolios. So what we see is we see a lot of people doing things that they probably shouldn't do. They're convincing themselves that certain yield investments that have a lot more risk don't have as much risk as they really do, and then they get a surprise later on. I'll say this though, that the economy will do whatever it's going to do, and right now we don't know what that'll be. But the stock market itself, which has been very negative and very sloppy, the old adage is the stock market has signaled 10 of the last 3 recessions. The translation is stock market reacts immediately. In 1962 and 1987 and other markets crashed, and then we didn't have a recession. So we might have a recession, we might not. The market's going down saying we will, but we won't necessarily because the market signals recessions that don't happen. So we'll see if it actually happens, but don't assume that we're going to have a terrible economy going forward just because the market is negative. For investors in this environment, I will always say this, putting it all together, that you shouldn't take risk that you can't handle. So if you can't take risk with a certain pool of money that you need in the next year or two, you shouldn't take that risk. There will be lots of opportunities when the markets finally bottom for people that are willing to take risk. But if you can't take the risk, you should somehow find a way to either hedge or pull that money out of the market. Folks that can take risk, maybe people who are younger, who have more time to let that money recover, they may choose to not take risk either. So no one says just because you're in your 20s, 30s, and 40s, you have to take risk. If you're uncomfortable with seeing your portfolio go down 10% or 20% and seeing the volatility of all that, you can also use protective action. Then on the other hand, the opportunities are some people will buy on the way down. So some have a strategy that in a market that's down big, they automatically buy some things because they think they're cheap. It might get a little cheaper, but they're somewhere near a bottom. Or others will say, I'm just going to sit on the sidelines for a while and wait till we see that the market's a bottom. The key, though, is to have a plan. So if your plan is to buy things on the way down and you're a risk taker, fine. That'll probably work for you. If you want to wait until the markets are bottoming, fine. But you should have a plan, and you shouldn't just guess and hope, because we're all emotional beings and we're going to make decisions that may not necessarily work out if we're just only operating on emotion. And make sure that you know what you're doing, and if you need some advice, you can consult an advisor, and we'd be happy to be that advisor. Every time a person buys, another person sells, and they both think they're astute. So when you take a look at the markets and the economy, take a step back from whatever you hear in the press. The press is there to sell papers. The media is there to get you to turn on their channel. Sell inflammatory lines, and negative headlines sell better than positive things. So don't let that get you caught up into all this. There's going to be great opportunities when this market bottoms. The key is just not to take big risk in an environment like this. So we'll be back with more comments later. We'll also be offering podcasts this year of different commentary between myself and Chris Reardon, and we think we'll offer some value there. So watch our website for commentaries that come out on podcast. And that's the FourStar commentary as we begin the year of 2016.